Welcome to Buying, Selling and Everything Else. In the first few videos, I've explained the process of buying, selling and the steps involved in them. What I want to do is interview the people that are involved in these steps and make these dreams come true. Today I bring to you one of the people that play a key role in the first step of buying a house. I've known Sam for over 10 years now. He has been in the financial industry for 15 years and has run his business for about 10 years now. Apart from running a successful mortgage broking business, he has a wonderful family with 2 kids, and I really don't know how he does it all together. So without any further ado, let's get into it. Sam Doe. First questions first. Let's start from the beginning.
Yep.
What is a mortgage broker? Why should people come to a mortgage broker?
What is a mortgage broker? A mortgage broker is someone that helps people guide them through the journey of buying a property or refinancing. Not going direct to a bank means that we work for you. We have options with lots of different lenders as well. So we try to specialize what we do, boutique it to your style and what is important for you. We will come sit down with you, go through all of your situation and work out what is best for you together with yourself. We won't just give you what is available to us if we're just a bank.
Okay, so you'd go out to someone's house, you're saying, and tailor the finances accordingly?
Yeah, so it depends on what you prefer. So I will still go out to people's properties and see them and go through it all. A lot of it is done through Zoom and video calls as well, and phone calls, emails, all that kind of stuff. But we still like that personal touch of being able to see people face to face if that's what people prefer and have time to do. Not every broker is the same in that, but the best thing is with a broker, you're not just a number. Usually you are a person, and we'll take your situation into account and work out what is best together with you, not just decide for you. And then from there, we'll be able to negotiate with the banks. So we'll start the process from the beginning. We'll go through everything, work out where you need to be. So you might not be in a position right now, or you may be. If you are, perfect. We'll work out what we need to do, work out what options we have, negotiate, find options with different lenders. Most of us have over 30 different lenders we can deal with. If you aren't ready, we can also set you on a plan. Go, okay, you're about 6 months away. What do we need to do? Saving a deposit. We need to make sure we need to pay some credit cards out. So we are there as a full, guide on your journey.
Okay. Now, for these services, does a buyer, for me it's a buyer, but for you a borrower, would they have to pay a service fee for you for a broker, or how do you get paid?
So generally, most brokers, or all brokers, will get paid a commission. So the bank sort of goes through a branch. If you got a loan, overheads, rent, electricity, wages, it costs them money. So they go, well, based on that, if we get a loan through a mortgage broker, it costs us X amount. So they'll pay us a commission because they wouldn't have got that loan if they we hadn't brought it to them. So most don't charge a fee. There are some brokers that will charge a fee, and that's just because whether it's specialized lending or because that's just their setup. I personally don't charge a fee. I know with banks, if you get refinance or sell within a year, banks will do a thing called clawback, and they'll take the full amount back off you. Brokers can no longer claim that back off you. So I know some brokers will actually charge a fee up front.
From the borrower.
And they'll refund it in 2 years' time. It's a weird thing to do. To me, it's a lot of paperwork. So
it's too much
accounting.
But
you'd say probably 90% of brokers don't charge a fee. I personally don't charge a fee. But there are some that feel that what their worth is an extra fee on top.
So just in case if someone doesn't get approved or the loan doesn't go through with you, you just cut your losses and move on.
Correct.
Would that be right to say?
Yeah. So not just that, it would be what is the reasons you didn't get approved? What happened? Did we know up front this was a situation you still really wanted to go ahead? And we said we'll chance it for you, and what can we do to get you approved in the future? Was it a default? Was it your savings wasn't right? Was your employment, or it was just a little bit shaky with your account conduct, which we generally would have picked up earlier anyway.
Okay, yeah.
But sometimes, a bank will say, oh, there's a 10% chance of it going through. The client really pushes us that they want to do it. You'll go, hey, it's unlikely, but I'm happy to do it for you. Yes, it'll cost us money because we'll do everything. We won't get paid.
Yeah.
But again, it's all about the client for me.
Okay, fair enough. What are the things that, like, I deal with a lot of first-home buyers that are coming through the apartments to buy apartments. What are the first step that you think that a first-home buyer should take towards getting his finances in place? Like, what is your tip?
Yeah, so again, the cliche, speak to a broker, because we will go through all that with them.
Yeah.
But the main thing is deposit,
Yes.
sorting that out, getting your accounts clean. So making sure you're not overdrawing accounts. So I know there's a lot of stuff like Barefoot Investor where having multiple accounts set up. If you do have that set up, you need to make sure you are on top of your management of your accounts. You having overdrawn accounts, yes, you might have money in another account, but it doesn't look great. We can get past it, but you'd prefer that to be better. Making sure any commitment you have, so a credit cards are fine.
Yeah.
Just make sure you're paying them on time. So credit rating got updated a few years ago where now if you actually miss a payment, I think it's for 14 days, it will actually note that you've made one missed payment on your credit score, and that stays there on your credit file for about 24 months. Back in the day, it was only if you defaulted after 60 days and then you went through the whole rigmarole. So now you will actually have it noted 000, which is perfect, or 1, 2, 3, 1. Bank sees that brings down your credit score as well, and also they then ask questions. So you can still get an approval with that, but it makes it much harder. So you want to make sure you're keeping on top of any of your bills that you have.
Yeah.
Not the most comfortable conversation, but if you've gone through a separation, make sure any joint bills, they're all sorted, because a lot of the times you'll have someone that didn't pay a phone bill that the other person was supposed to pay, and all of a sudden they've got a default.
Yeah. There's always a story behind a mispayment.
Correct.
So, like in my previous video, when I was talking about the process of buying a property, this step that comes before meeting a broker or before getting your finances ready, how crucial is it?
As in the step before?
The step before, because everywhere you say, talk to a broker, talk to your bank, get your finances approved. But the step before, according to me, is getting your deposit ready.
Yep.
And cleaning up your bank accounts, as you just mentioned. Is it like, because that then tailors into your credit score.
Yeah.
So, the question could be, how important is the credit score in this whole process?
So credit score is very important. There are different banks that will look at not factoring it in, but in general lending, if you're looking at the standard kind of lending, yes, you generally need a credit score over 500 to 600 depending on the bank, and it also factors in your deposit. I will say that those things are your first step, but again, bringing it back, I think seeing a broker, because we don't just do today. Well, I know I just don't do today. So I will speak to a client that might be 2 years away. And the reason I speak to them then is we're having that discussion about how much deposit do you need?
Yep.
Because if you say first step is I need to get a deposit, what is that deposit?
Exactly.
You don't know the amount.
Yeah.
What is my credit score? I don't really know. So then a broker or myself can tell you where we can look it up. We can look it up ourselves, or we can send you to the right place to find your credit score.
Okay.
And then we go, okay, what are you aiming to for a purchase? Okay, well, if it's 500,000, you need X amount. If you're a first home buyer, you need this much. If you're a second person, you've got equity. So trying to say, come up with a deposit yourself is a good goal. Saving is a good goal, but you don't know what you're saving. So once you sort of see a broker, you actually know your goals. And I find that when I see clients, they're like, hey, I was thinking about it 6 months ago. We started saving, but didn't know what I was saving towards. Then I see them after 6 months, like, your actual goal is 25,000. They go, that actually quantifies what I'm trying to do. And it breaks it down. I know I can get there in 12 months. This is what I want to do.
Yeah, love that. Have a target in place, know what you want, and then you can show them the way how to get there. Yep. Awesome. All right. Just a little break. Go through the questions. You feeling all right?
Yeah, was that okay?
I think That was pretty good. Hey. Okay. All right. Next question. Do you think first home buyers have it a lot tougher these days than someone that has already borrowed before?
Yes and no.
Okay.
So first home buyers have it tougher than someone that already owns a property.
Yeah.
Because someone that already owns a property is already in the market, has hopefully got a property that's probably already increased in price. So the entry point now for a first home buyer is a lot more, which you'd see, right? Yeah. Your units are more popular now because they are that entry level.
Yep.
Where to buy a house under 500, you're in Ipswich, and even that you're probably far in Ipswich.
Yeah.
Even in your Logan area, you're getting quite far, or it needs a lot of work.
Yes.
Where previously you could buy pre-COVID, I don't know if we're allowed to say that word here, but you could buy a property in Logan for $300,000. So it's nearly doubled. So that's probably the hardest thing for first home buyers, is that the price to entry is so high.
Okay.
With regards to loans, if you're of say you've bought a property in the past, but you don't actually have a property now, I think it's actually easier if you're a first home buyer because of what's available to first home buyers now.
Yeah.
So as long as you're a permanent resident or a citizen of Australia as a first home buyer, as long as you buy for under 700,000, there's the first home buyer scheme, a guarantee scheme, which is where the government will go guarantor for you. So they put up security. Instead of having a parent go, I've got a house they can give you, the government will put up security for yourself. So you can buy a property with a 5% deposit plus cost.
Yeah. Okay.
So where generally you need about 8% plus cost, and on top you get mortgage insurance. So this was 95% loan, no mortgage insurance. Yeah. So at a $500,000 purchase, $25,000 plus a couple grand for government costs, no stamp duty, but government costs. So $27,000 is all you need for a $500,000 purchase.
Wow, that's quite doable. Like in the Stone Age,
Where if you've owned a property before, you generally need 8 to 10% plus the stamp duty on top. So you're looking at, say, we'll call it $40K for the 8% plus about 15 grand for government charges.
Yes.
So you're about 55,000. So your entry point is nearly 30 grand more.
Okay, so pretty much double, you'd say that if you're a first home buyer with under 500,000, you can get in with 27,000 in your pocket. And if you own property in the past, it'll cost you about 50.
Correct.
Yeah, cool. That brings me to my next question, which is, hang on. Come on, what is it called?
Super scheme.
Yes.
Super saver scheme.
What was the first home buyer super saver scheme? So next question, is which brings me to the next question is, what's the first home buyer's super saver scheme?
The super saver scheme for first home buyers is where you contribute more to yourself, so your superannuation. Okay. So you say to your employer, hey, I know my super is 11%. I'd like to contribute on top of that another 2% or 5%. So the government allows you to contribute to your super, which is then at a lower tax rate of that 15% mark instead of being at whatever tax rate you're at. They do have caps on it, where I think it's a total of about 25,000 over 2 or 3 years that you can contribute to it. And then you need to obviously let your super know. And then when you go to buy your first home, you can actually go to your super, and there's a form with the government as well to say, I want to access that $25,000 towards a purchase for my first property. And you provide that to the bank, and then they will make it available for your purchase. So that's what's available at the moment. Though you do see less of that because, one, people aren't aware, and it's also forefront of thinking of, do I put it in there as a savings, or do I put it in my own bank account as a savings? The biggest thing is that the 15% tax bracket.
I was going to say the drop in the tax bracket, because if you're going to save it yourself after tax, you've paid 30% or more on the money that you earned. Whereas while if you get it as a contribution, it's going pre-tax.
Correct.
And when you get it out of the super, is it taxed then?
So it's just at that 15%. So that whatever it's at, then it comes out because you're showing that it is for that purpose. If you decided that you wanted to pull it out and they found out you didn't use it for a property, then it would be taxed at the full amount.
Full amount. Okay, fair enough.
So with for first home buyers, as I was mentioning earlier, the main schemes that are looked at, or what's helping buyers the most, are the stamp duty if you can buy under 500,
Yeah.
and then your first home buyers grant, which is for brand new builds, which is being boosted in Queensland to $30,000 at the moment.
Yeah.
And so as long as you're not building or your total property value isn't over 750, you can get 30,000 from the government, which can go towards your deposit. And then the guarantee scheme we mentioned earlier, that seems to be the real one that's helping, because the amount you have to save is a lot less. And that entry point makes it a lot easier.
And there are no restrictions that it has to be a new build or anything like that way? Is it
with the super scheme, saver scheme, no restrictions on new or old builds. You can buy an existing property, no issue. Same with the guarantee scheme, no restrictions, where the first home buyers grant of 30 is for new builds or never been lived in before.
Okay, fair enough. Okay, what have we not done? Okay. All right. I have these debates with a lot of my buyers, and what does a pre-approval mean? Does it really mean anything, or it's just a computer generated going, yep, you can borrow X amount of dollars?
Pre-approvals, whether they mean anything or not, really depends. So what that means is some brokers will just go, you're pre-approved, provide nothing. That means nothing. That could just mean I'm just doing some calculations and it looks fine. Don't worry about it. Then there's the other two types, which is both to the bank. So you submit a full application to the bank, and as you said, computer generated. Majority of banks have moved that way. The reason is with the market on how hard it is to find a property. The conversion of a pre-approval is very low. So they sort of see, well, we're spending money getting these pre-approvals approved by putting it through a person. We're not getting the return. It costs us money. We can't charge the client until settlement. So if it doesn't go through, they go elsewhere. We've spent a lot of money and resources. So they've gone, we'll do an AI. And a lot of banks will say, as long as everything is inputted, 95% of them convert. But it's those intricate things on pay slips that don't get picked up, something about the situation. Sometimes it doesn't actually do the credit score, which I've seen previously.
Say credit scores
done, and it will pick up in the generation in the system, and it will make the AI will pick that up. But sometimes it hasn't, which I've had pop up. With that, it really comes down to the client situation, if it's worth doing that or not. If your situation is very, very simple, and say, for instance, your maximum what you can borrow is $1 million, but you borrow you want to only buy for 500,000. In that situation, you might not need one. You're putting in a big deposit, all that kind of stuff. It's very, very unlikely that you won't get an approval.
Another thing that I've seen, as you know, I've been in banking for 12 years before I got into this, but I would see where a client would hide a credit card or an account. Is there a pickup on that now?
Yeah. So I'll firstly just want to come back with the pre-approvals. There are the other form of pre-approval is a full pre-approval. There are still some banks that are doing full pre-approvals where they're going through the full process. We're going back and forth with the bank, getting it to pretty much just get us a contract. They are real. The only, I guess, risk with that is if the valuation falls short. Though generally, if they got an auction as an example, that's perfect market conditions. It's very hard or very rare for a valuer to justify a price less than what it's been bought for,
especially at an auction.
Correct. So with your question earlier about pre-approvals worth it, yes, they are. If you need them, and as long as they go to the right lender. So that's why you speak to a broker, because they will put you to the bank that will actually do a proper pre-approval.
Understand.
With your question that you just asked now, can you repeat?
Okay. I've seen in the past where when I was in banking and doing loans, where either they'd slip up and not give you a statement, or credit card is hidden or something like that. Does the AI or the bank searches pick up that one account that
You did mention. So generally most lenders now do report. So it will come up on your credit file.
Okay.
It's very hard to hide. Also now banks have this thing called open banking where they can technically, can't explain it exactly, but they can pretty much look into other people's accounts with other lenders to an extent.
Oh, with other lenders. Okay.
Correct.
Yes.
So they can see everything that you have. It's getting more and more open. And then with the credit reporting, most people that will give you a credit card or same day pay or anything like that will report it on your credit file.
Okay.
You will see where it can slip where you have a few different reporting agencies out there. So it might not pop on one, but it will pop on the other.
Okay.
But we do look at 3 months worth of bank statements. So generally we will see it.
Okay, yeah.
But definitely know the style that you're talking about back in the day.
Because you know how it is.
That
takes me to the next one, which is afterpay.
Yes.
And a number of those kind of facilities that that person can have. How does that affect a person's borrowing capacity? Because I know credit cards and stuff do affect it.
Depends on the style. So something like Afterpay is seen as like a pay now, pay later, like a lay-by system.
Yes.
So that is actually factored into your living expense. So in your living expense, one of the categories will be food or will be clothing as an example, or entertainment. So in your clothing section, if you factor in $500 a month in clothing and you can see your Afterpay is what you're spending is about $500 a month, that's factored into your living expense. So that doesn't impact it. Something like ZipPay, and there's a couple other ones where they're seen more as a credit limit. They're seen more as a credit card. So the limit will be taken as what's available. So say $3,000 and then the bank will treat it like a credit card and to take the repayments at 3.82% of that limit.
All right. That clears it up. But I always had this doubt, like, because these are new lending facilities that have come out since I left the game.
No, correct. And for a while there, even the Afterpay was treated as a debt, but then they sort of go, no, well, it's part of your living expense. And it is more of a floating limit, so it's harder to lock down what you contribute to it.
The limits are not too bad either on these kind of facilities. They're usually around $2,000, which is, it's okay. Okay. Get back to the paper. An offset account. Now, probably a lot of us know what is an offset account, but if you could explain what is an offset account, number one, and is it something that you recommend to every homeowner, or is it not for everyone?
Yeah. So what is an offset account? In essence, it's like a savings account. You would have your main home loan as a variable loan in most situations, and then you'd have this transaction account where, say, for instance, if you had $30,000, you would generally have had it in a savings account. So instead, you'd put it in your offset account, and what that does is it offsets the interest generally, dollar for dollar. So say if your balance in your home loan was $100,000 and you had $30,000 in your offset account, the net balance is $70,000. So you get interest on the $70,000.
So you charged interest on $70,000.
Correct, on the net balance. Though that transaction account, what's good about it is flexible, as in it can be used as a transaction account for direct debits, bills, have a card attached to it, like a debit card attached to it to do all your spending. So that's what's good about it. Some banks will even let you have multiple. So what that means is you can have one just as your holiday account, and that just sits there, still has the same benefit. Then have your everyday bills account. That way, you can still separate, manage your money, but have that benefit. Is it for everyone? Depends on how you are with your money. So some people will see an offset account and see $30,000 in there and say, I have $30,000 to spend. Do you have $30,000 to spend? So what some people will prefer to do is with a variable loan is use their redraw. So a redraw is where, again, you say your limit on your loan is, or balance was $100,000. You put that $30,000 directly onto the loan. So now you've still got a limit of $100,000, but it's been brought down the balance to 70. So you get charged again only on the 70. But instead of being able to see it in an account just sitting there, it's available as a redraw. It's that extra step to pull it out to use it. So mentally, you go, if I'm pulling this out, do I really need to be pulling this out? So it's sometimes better.
Could be good for some people.
Correct. I know there is a bank out there that will actually do a and I know they'll do it with their savings account. If by pulling this out, you're actually going to put yourself 2 more years away from your goal of this holiday or whatever it may be.
Yes.
So it's that mental game there, and try not to touch it.
Yeah.
With offset accounts, a lot of the times there will be a fee. So that's where it comes into, is it for everyone? If you're only going to have $1,000 in there at all times, it's probably not going to be enough to save the interest that fee is going to cost you.
So all offset accounts do come with a fee?
Most of the time.
Okay, yeah.
So there are a couple of lenders that won't, but what happens is there's a lender there that doesn't have a fee for either, but the rate is higher. So then you sort of factor that in. So if the rate's going to be higher, then it's not worth it. If there's going to be a fee there, but the rate's going to be lower, then there might be a point. So it really just comes down to your situation and the bank that you're going with as well. But generally, if you're not going to have a lot in there, you don't need an offset account. Having an offset account won't hurt, but you don't need it sometimes.
Okay. How are we going, gentlemen? Enough? I think I've gone through everything, isn't it?
The one that my missus asked me that I stuffed up was is it easier for business people to get?
I haven't gone into that yet. Do you want to go into that?
No. I thought you were finished.
That's the only one that's left.
I was like,
all right, let's do the last one, eh?
Is that the last? Are we nearly done?
Yeah.
Oh, man.
Right. I think we've gone half an hour through, isn't it?
It'd be a good idea to do that, and then we'd probably...
Yeah. Brisbane.
I've got that, so I'll do that separately.
Yeah.
So I'll run it through with you before I do it, because if you want to go, you can go and I can do that.
I hate speaking.
Yeah. All right. For a person like myself being in business, how hard is it to get a loan? I know back in the day it was pretty much impossible after the GFC. Your take on it?
Self-employed business owners can be more difficult, I guess, because of the time. So when you're self-employed, you generally need to be running your business for at least 2 years.
Okay, yeah.
And generally would need to show 2 years worth of tax returns and financials. Where if you're PAYG, like work for someone, you could literally get a loan after a month of full-time and permanent employment.
Well,
so the difference of entry is huge.
Yeah.
With the other issue, I guess, or hurdle when you're self-employed is if your accountant is too good. So what that means is you're not paying any tax, but your taxable income is too low. I've had clients where their tax, they think they're making 150, though their tax return says 25,000, and 25,000 won't get you much, unfortunately. So the biggest things are when you're self-employed is good bookkeeping, having a good accountant in both ways, and having a profitable business with the 2 years. There are other types of loans I won't get too much into with regards to low docket, all that kind of stuff. There are other entry points, but generally your deposit that you require is a lot higher. Banks have brought in things that have made it a little bit easier for self-employed people, and that is if you have a company structure, as an example, they've actually brought in pay slips. So they've gone, as long as you're paying yourself a wage and you can get an accountant to say that you're profitable, give us 6 months worth of pay slips, transaction, we will treat you as PAYG pretty much. So that is a couple of things that banks are doing, which makes sense. Why can someone that's employed by someone else who could be working for a company that's going under get a loan? You're working there for 2 weeks where, you run your business, you're going to run it better, you know what your business is looking like and you're being consistent with it and you run it for 2 years still, why can't we give you a loan?
Let's get into the dirty word, low doc.
Low doc.
lot of brokers or banks don't know. Do they do them still? Do they touch them? What's
low doc? The dirty one. Pretty much. If it's a standard lender like your big fours, anyone that you would see as like a first tier lender, no. They I think some would say they'll do like a low doc 60, but they won't really touch it. So generally what you're looking at is your second tier and your third tier lenders. And they will do things no doc, low doc, alt doc. They're just different words to pretty it up.
Yes.
Pretty much. with those, you generally need at least a 20% deposit.
Yeah.
Even at 20% deposit, you will still pay not mortgage insurance, but like a risk fee.
Risk fee.
So
okay.
they go, well, you're risky. We're taking your word for your income.
Yeah.
With income, you're looking at things as BAS, you're looking at trading statements, and you're looking generally relying on an accountant to fill out a document provided by the bank to say you earn X amount.
Yeah.
Obviously, all above board, that's why they're writing it. They're saying, yes, they make this. They just haven't had a chance to do their tax returns because of X, Y, and Z.
Yeah.
So that's how those work. But the rate is generally loaded because of the risk. So you're getting
So how much do you think someone with a low doc basically low doc is a loan without any documents? The borrower has just stated, I make $1 million a year. The bank with the accountant's signature would go, all right, we accept he makes $1 million a year and we'll give him the loan.
Correct.
So huge lot of risk over there. So how much do they load the standard?
So standard rates at the moment for owner occupied are between roughly 6 to 6.5%. So they can be a bit higher, but that's where they sort of sit. When you're looking at the low doc space, you're probably looking at roughly a 2% on top.
Yeah.
And it can go higher depending on the risk they've seen, the background, the type of property and all that kind of stuff, because then they delve into more specialized things like that.
All right, Sam, thank you so much for coming over. It was absolutely a joy interviewing you, and I'm very sure everyone that listening to this video will definitely take something away and learn